All right, good afternoon, everyone. Thank you for joining us in today's webinar. I'm Gab Aguila, Head of Research for Unicapital Securities. And for today's webinar, we'll be sharing with you updates on the global economy, as well as the Philippine equity markets. We likewise be sharing our views and recommendations on how you can best manage your investments given recent events, which make the current situation all the more challenging. Today, I will be joined by two distinguished speakers, Mr. Henry Herrera, a well-known expert, and Mr. Ben Thomas Pañares, the President and CEO of Unicapital Securities, Inc. And just a few reminders, as everyone is currently on listen-only mode, please feel free to ask any questions via the Q&A tab of the webinar interface or use the chat function to raise other concerns. We'll be having a Q&A panel session with our speakers towards the end. So without further ado, I would like to introduce our first speaker who will be sharing with us his outlook on the Philippine financial markets, its key risks and events to take note of, and its possible impact on the debt and equity markets. He's a well-known investment expert, passionate about sharing his thoughts and ideas on investing, and as such is known as Mr. PhilInvestor. At present, he is also the chairman of the board of Ahon sa Hirap, a microfinance institution for the poor. In December 2021, he retired from the board of PruLife UK Philippines Incorporated, where he served as a chairman since August 2012 and as a member of the board of directors since 2010. He also served as a member of the board of the ATR Kim Eng Mutual Funds family and served as president and CEO of Sun Life of Canada Philippines and Sun Life Asset Management from 2007 to 2009. Let's welcome our guest for this afternoon, Mr. Henry Herrera.
A pleasant good afternoon to all. Thank you, Gab, for the introduction. Today, I will talk about the Philippine financial market outlook. Let me start by taking a quick look at some COVID-19 statistics. While we have seen a spike in new cases on account of the Omicron variant, new cases have since dropped. Despite a spike in new cases, daily deaths peaked at much lower level in February this year. Alert Level 1, which lifted mobility restrictions, has been in effect in NCR and most other parts of the country since early this month. Offices and establishments are allowed to operate at 100% capacity, and schools are preparing for face-to-face classes by the start of the school year. We will be playing catch-up with the other countries that have lifted mobility restrictions much earlier. As such, we are expecting a normalization of activities back to pre-pandemic levels. This bodes well for the business sector and the economy as the country has implemented one of the longest lockdowns since the pandemic started. In the week ending March 27, Department of Health reported 0 new severe and critical cases. Average daily new cases and deaths continue to decline. Vaccination levels continue to improve at 73% of target population and 75% for seniors and those with comorbidities. Let us now take a quick look at GDP growth rates for the top 6 global economies and the ASEAN 6. For most of the big economies, the World Bank expects slower growth this year compared to last year. This is on account of rising inflation, supply chain bottlenecks, and unwinding of fiscal and monetary policies. Please note from the table that the Philippines suffered the biggest GDP decline in 2020, a reversal from 6.1% growth in 2019 to a decline of 9.6% in 2020. The lockdown measures adopted by government, ECQ, MECQ, GCQ, and MGCQ took its toll on the Philippine economy. Thus, we expect a strong bounce as we head back to pre-pandemic economic activity. Nevertheless, as has often been the case, economies go back to previous growth patterns after crisis years. 2022 is no different as practically all 12 economies are projected to be on track on pre-pandemic growth patterns. The chart shows a continuation of economic growth if we black out the economic results for the last 2 years. As shown in the table, GDP growth among the emerging markets has been significantly higher than those in advanced economies, even prior to the pandemic. For 2022, among the ASEAN 6 countries, growth in the Philippine economy is projected to be the fastest. Let us now take a quick look at stock market returns in 2021 and year-to-date 2022. India topped the list among large economies with a return of 29% in 2021. Returns on stock markets in the US, Germany, and UK ranged from 16% to 27% last year. On a year-to-date basis, however, except for UK and India, the stock markets in these countries have reflected negative returns. Vietnam posted the highest return in 2021 among the 12 countries and is currently lagging the ASEAN 6 in terms of year-to-date returns. The stock market in China performed the worst last year and is again lagging this year. The crackdown on the technology, entertainment, and education sectors and issues on its real estate sector continue to weigh down on its market. Together with Malaysia, the performance for equity markets has lagged our peers in the region. The PSEI has marginally inched up by 1% since year-end 2020. It is not uncommon for investors to favor investing in asset classes, sectors, or even companies that have performed well in the past. This approach does not work well all the time. The caveat remains that past performance is not an indicator of future performance. It is not unusual to see asset classes or stocks that perform badly in one year perform very well the following year, and vice versa. Let us take a look at the PSEI's top gainers and losers last year and year to date. 5 of the top 6 gainers last year among index stocks are now among the top losers this year. Emperador, Wilcon, Globe, Manila Water, and Ayala Energy were among the top gainers last year. Year to date, these same stocks are among the top losers. On the other hand, 2 of the top losing stocks last year are among this year's top gainers. These are JG Summit and SM Prime Holdings. We see another example of rotational buying and selling this time among the index stocks in the PSEI. Markets are forward-looking, and future earnings outlook and valuation metrics are key determinants of returns. Thus, rotational buying and selling among asset classes all the way down to individual stocks are not uncommon. After briefly tackling the returns on stocks, let us now take a look at the trends in bond yields. On the screen are the movements in yields on 10-year government bonds for the US and Philippines for 2021 and year to date. Notice the similarity in movements in yields, both for 2021 and year to date. Knowing this high correlation will help us better understand the bond market outlook this year. We shall go back to this later when we discuss the key risks as the US Fed starts raising interest rates on federal funds. At the beginning of 2021, yields on 10-year US government bonds stood at 0.9%. The very low interest rates have pushed many investors to switch to equity markets. Thus, the term TINA was coined. It stands for there is no alternative. Because interest rates are very low on fixed income instruments, a lot of funds have shifted into equity markets. Even when the returns on the yields on government bonds are way below inflation rates in the US. We have seen the yields on US bonds gradually increase last year. As inflation rate continues to rise in the US, the pace of increase in the yield on US government bonds accelerated. Year-to-date yield on 10-year government bonds has already increased by 90 basis points, much higher than the 60 basis points rise for the entire 2021. The Philippines, on the other hand, saw the yields on 10-year T-notes increase by 180 basis points last year and 100 basis points so far this year. As a result of the substantial increase in local interest rates last year, mutual funds invested in Philippine bonds mostly posted negative returns. The further increase in yields this year caused further losses in said mutual fund investments. Having had a glimpse of financial market performance last year and year to date, let us move into a discussion of some key financial indicators that may indicate or determine the outlook of the local bond and equity markets. NEDA's GDP growth forecast for the year 2022 ranges from 7% to 9%. This is substantially higher than those made by World Bank and ADB at 5.9% and 6% respectively. Also worth noting is that in all these three forecasts, the country's GDP by the end of 2022 will be bigger than the pre-pandemic level. The total GDP by the end of this year is estimated at 101% to 104% of pre-pandemic GDP. Next, we take a look at unemployment rates in the Philippines. Since about 70% of the Philippine economy is attributable to personal consumption, continued decline in the unemployment rate is critical to the attainment of GDP growth targets for the year. The unemployment rate continues to drop. At 6.4% in January this year, it remains higher than the pre-pandemic level of 4.6% in January 2020. As most parts of the country have been placed under Alert Level 1, lifting previous mobility restrictions and limitations on establishments, we expect to see further declines in the unemployment rates in the months ahead. This bodes well for the business sector and the economy alike. At this point, let me take another look at the yield on Philippine 10-year bonds, this time in relation to the inflation rate. We see another high correlation between the two indicators. And since we expect inflation to head higher in the short term due to the impact of higher oil prices, we may also expect the yield on 10-year Treasury notes to head higher as well. We know that as interest rates go higher, bond prices go lower. Thus, the outlook for bond investments in the short term is negative. This may not be the best time to lock in on long-term bonds as interest rates are expected to continue rising in the short term. Let us now move into the earnings outlook for various sectors in the PSEI. Banks are expected to post robust earnings growth this year on wider interest rate margins, lower loan loss provisioning, and increased lending activities. Continued recovery of the property sector and the conglomerate sector are similarly forecasted for 2022. With business activity going back to near normal levels this year, earnings growth in the PSEI listed companies is projected to be the highest in the last 4 years. On the valuation front, in terms of price-earnings ratio, we expect a reasonable overall PE ratio of 16.6 times for the PSEI, around the same level in 2019. We see opportunities in the banking sector, property sector, and conglomerate sector. The PE ratio for these sectors are seen to be lower versus the other sectors and also lower versus pre-pandemic PE ratios. Also, at the projected PE ratio of 16.6 times, the PSEI is trading at a discount to average PE multiple of 20 times since 2013, when the Philippines achieved investment grade status on its sovereign credit. Finally, we'd like to highlight the significant influence of net foreign buying and selling on the PSEI. In the years 2009 to 2012, 2014, and 2017, where we saw heavy net foreign buying, the PSEI posted strong gains. In the years 2013, 2016, and 2021, where net foreign participation was minimal, the PSEI hardly moved. The PSEI posted declines in the years where we saw heavy net foreign selling. If the next president is viewed positively by foreign fund managers, we may see them taking a strong interest in our local markets again. This was evident if we look at the years 2009 to 2012. During the tail end of the last global financial crisis in 2009, the PSEI rose 63%, while GDP grew by only 1.5%. Foreign fund managers have been net sellers in the PSEI for most of the last 4 years, practically negating the net foreign buying since 2012. Thus, the PSEI has languished below its all-time high of 9,058 achieved in January 2018. Keeping tab of net foreign activity in the PSEI will help the investor with the large cap holdings in the PSEI. In summary, stocks are favored over bonds this year. Positive GDP growth expectations, projected strong corporate earnings growth, and reasonable valuations are key factors. Further, rising interest rate expectations do not augur well for bond investments in the short term. Understanding that stock investments generally exhibit much higher volatility compared to bond investments, investors are cautioned to keep within their investment objectives, risk tolerance, and understanding of markets, among others. While your account officers and brokers at Unicapital may give you insights and advice, the ultimate responsibility for your investments falls solely on yourself. As with any investments, there are key risks and events that may alter the outlook of financial markets. A key risk factor is the projected rate hikes from the Federal Reserve Board on rising inflationary concerns in the US. The Fed has raised interest rate on federal funds by 25 basis points earlier this month, its first since 2018. The Fed signaled further rate increases for the balance of the year and possibly into next year. Inflation rate reached a 40-year high in the US early this year, and the Fed added that the war in Ukraine and related events are likely to create additional upward pressures on inflation. The last time the inflation rate in the US was at 7.9% was in 1982, and the yield on its 10-year government bonds at that time were near double digits. The Fed has to perform a balancing act in raising interest rates to curb inflation, while at the same time managing the magnitude and timing of the rate increase so as not to stifle economic activity. Inflation rate in the Philippines is far from reaching high levels at this time. It stood at 3% at the end of February. As such, the need for aggressive interest rate hikes by the BSP may not be in the same magnitude and urgency as with their US counterparts. We have also seen that the economic and fiscal challenges brought about by the pandemic has resulted in substantial increases in fiscal deficits and debts of practically all countries. As a result, some countries' credit rating outlooks were downgraded, and some even experienced credit rating downgrades. Debt to GDP ratios of most countries have ended much higher compared to pre-pandemic levels. On the chart, we see that US debt to GDP ratio rose from 105% in 2019 to 137% last year. The ratio is more than double their debt to GDP ratio prior to the last global financial crisis, which stood at 62%. The Philippines, on the other hand, saw its debt to GDP ratio also rise from 40% in 2019 to 61% last year, a level last seen in 2005. We've seen countries, in particular the PIGS, or Portugal, Italy, Greece, and Spain, go into debt crisis following the last global financial crisis. It bears watching if something similar will happen in the coming years, as equity markets globally were affected then. On the account of very low interest rates in the US, we have seen significant gains in the US stock market in the past 2 years as funds move into that particular investment class. This has brought about valuations to relatively expensive levels versus historical norms on several measures. Relative to fixed income instruments, valuations remain fairly reasonable. The situation may change as interest rates are expected to continue rising. At relatively expensive levels, increased volatility in US stocks may not be unexpected as the US equity market outlook may be under pressure. Other key risks include the endgame of the Russia-Ukraine conflict. Hopefully, the conflict ends sooner than later. We do hope that the conflict does not escalate and involve other countries, as the outlook for the financial markets may turn dim. Locally, the 2022 national elections are closely watched by investors, both local and foreign investors. A victory by a presidential candidate who is viewed positively by investors may see a re-rating of Philippine equities. We may see a return of net foreign buying into the Psci that may push the index way higher than a lot may have anticipated. Finally, a new COVID strain or variant of concern may cause another delay on the return to normalcy and may lead to missed economic or corporate earnings targets. If the recent spike in new COVID cases is any indication, new variants may simply postpone the economic growth trajectory and not cause a reversal. In summary, the Philippine economy is expected to continue its recovery. Bond fund returns will be negatively impacted by the short-term interest rates as it continues to rise. We see strong earnings growth and reasonable valuation for PSEI-listed firms. Given this, we favor stocks over bonds. We reiterate that investment decisions must align with your objectives, risk tolerance, and understanding of markets, among others. Investment themes include an overweight in select banks, property counters, conglomerates, and other themed stocks. Consider diversifying into emerging markets as stock markets in advanced economies pause on extended valuations amid rising interest rates. Monitor key risks and events that may significantly alter the financial market outlook. Finally, while your Unicapital account officers and brokers will provide guidance for your investments, the final investment decision will be yours to make. Good afternoon once again, and thank you very much.
All right. Thank you for your economic outlook, Mr. Henry Herrera. Okay. And for our portion, for USI research, we put our focus on Philippine equity building on Mr. Herrera's assessment of the current and economic times tailwinds and headwinds as we navigate our way through the uncertainties amid the turbulent start to 2022. And building on what Mr. Herrera has mentioned, the PSEI for the first quarter of 2022 has so far been volatile, with a downside driven early in January by the surge of COVID-19 infections due to the Omicron variant in early January, and more recently by the Ukraine-Russia crisis and the US Fed's decision to raise interest rates, causing volatility in the rest of the global markets as well. The headwinds have been counteracted with much effort on optimism of the country's economic recovery trajectory, as indicators have shown that we begin our transition from a pandemic environment into an endemic one, which points to a reacceleration of consumer and business activity with the first hurdle to achieve pre-pandemic levels. In relation to regional markets, the PSEI have remained buoyant alongside emerging markets on the ASEAN region, while developed markets are less attractive in view of higher sensitivity to the rising interest rate environment, as what Mr. Henry Herrera has mentioned. The PSEI, so prior to the rotational outflows brought about by the US Fed's announcement to hike policy rates, the PSEI was among the top 4 in year-to-date return alongside Indonesia, Thailand, and Singapore. And in relation to what Mr. Henry has said, out of a focus of emerging markets, through the first quarter of 2022, we have observed semblances of a focus on the TIPS theme, the Thailand, Indonesia, Philippines, and Singapore. That was a strong theme among international investors at the start of the bull run cycle of 2013. This bodes well for the PSEI in the coming quarters as the Philippines reemerges from the pandemic's economic recession. Currently, the primary headwind on the Philippine economy is the surge of oil prices to elevated levels, primarily driven by the Russia-Ukraine conflict and its resulting effect on inflation. As Philippine businesses scramble to recover lost ground and opportunities, the elevated prices of oil threatens to compress already pandemic-tattered margins and the outlook of healthy consumer spending as consumers' income allocations become redirected to fuel costs. However, with so far low inflation leading up to February 2022, we do have some elbow room to effectively manage inflation. Further, the BSP has given guidance on the sensitivity of Philippine inflation to oil prices. At $95 per barrel levels, domestic inflation would be at 4%, still within the range of the BSP's target. At $120 per barrel, it would be at 4.4%, and at $140 per barrel, it would be at 4.7%. Latest BSP forecast estimates 2022 inflation to be at 4.3%, And that points to consideration of oil to be at 120 US dollars per barrel, where we see oil now to be currently stabilizing between 110 to 115 US dollars per barrel. Fortunately, as the US revealed surprise inventories, OPEC Plus countries striving to meet demand, and the prospect of China's economic slowdown to ease the demand of crude oil prices have retreated from its 14-year highs. Overall, we do see the heightened oil prices to be transitory. The initial rise in oil prices have been largely driven by world economies scrambling to jumpstart economic recovery efforts and simply exacerbated by uncertainties brought about by the European crisis. As these headwinds in world economies balance out, we will see oil prices ease back down to rational levels. In our figure below, we have tracked household consumption to have achieved pre-pandemic levels at the peak of mobility in December 2021 and January 2022, which also peaked above pre-pandemic levels as well. Retail foot traffic, the green line, has so far recovered and outperformed pre-pandemic levels during the height of the holiday season. Increasing mobility has been translating into increased household consumption, as you can see on the yellow line, last year in 2021. And we expect that trend to continue in 2022, spurred by the continuing slump of COVID-19 cases, whose trajectory we see to be downwards as the government's inoculation efforts continue. Consumer retail segments of the listed property sector are beneficiaries of this correlated trend. Names such as Smph, Ali, RLC, and Meg come to the forefront. And in effect, next in line to benefit would be consumer food service, such as pizza, Maxis, and especially JFC. Further, as headwinds on oil and inflation ease and lighter mobility restrictions with the prospect of alert level 0, consumer manufacturing would also benefit from the out-of-home consumption. Names on this matter would be URC, Monde, FB, EMP, DNL, and other consumer manufacturing brands. In relation to the consumer retail segment of the property companies we mentioned, the residential segments of these companies are also in a recovery and growth trajectory. Real estate demand showing visible signs of recovery with a rebounding GVA, or the contribution of real estate activities to the GDP, sustained increasing loan take-up for real estate activities despite the pandemic as borrowing costs were low, and higher residential property prices by the end of 2021 sets the stage for a recovery and an opportunity for strategic growth for property companies. For consumer manufacturing, input costs puts pressure on the margins for the rise in prices of input commodities. These were first driven by the pandemic exit recovery efforts by world economies at the start of the year, then exacerbated by the global supply chain disruption from the Russia-Ukraine crisis. As the recent surge is driven by conflict, of which global pressure has been mounting to end it, our view is that overall the surge is rather transitory and would normalize later in the year towards 2023. As such, the battering of URC and Monde with regards to its stock price, we see as good buy opportunities for investors with a long-term perspective. In the power sector, the economic reopening efforts of the country will drive increased power demand for 2022. We like power for its resiliency as it's withstood the pandemic shocks and with the ability to pass on input costs to consumers amid heightened oil prices, although at a rational rate. The freedom of mobility under Alert Level 1 will drive increased power demand in commercial and industrial segments, where we already saw an uptick in 2021 amid ECQ lockdowns and Alert Levels 2 and 3. And the summer season and the election-related power consumption forecasts the highest peak demand in 4 years, where both distributors such as Meralco, transmitters such as SGP or Synergy Grid Philippines, and Gencos such as AP, CREIT, and FGen will benefit. With the global perspective of COVID-19 shifting into an endemic disease, propped with the country's increasing vaccination rate, businesses and schools are planning to revert to face-to-face arrangement with increased capacity, and this improves economic activity as well as power demand, especially in the commercial sector. And with the broad economic recovery efforts, a need for funding for consumer needs and for commercial capital requirements for capex, working capital, and other general corporate purposes, we have the banking sector. 2021 has already shown a glimpse of recovery of loan demand as NPLs have also eased. We have also seen the unwinding of loan loss provisions. In our communications with the big three, BDO, BPI, and MBT, they have noted that the use of proceeds for loans applied for commercial purposes have started to shift from a business conservationary stance to expansionary use. Here, we present the loan books of the big three, and we especially like BDO for having been able to grow their loan book, although just at a slower pace amid the pandemic where other banks experienced a decrease. Where we also see growth for the banking sector on top of the return of loan demand is that banks are beneficiaries of a rising interest rate environment, as higher lending rates will translate into the recovery of net interest margins and net interest incomes of banks. While we hope that the interest rates do not hike at an unreasonable pace in response to global factors that could curtail loan demand, a reasonable rate of increase will benefit both the banks in terms of profitability and borrowers in terms of the ability to sustain loan demand. And as the leader in 2022 year-to-date returns on a sectoral perspective, we would like to note that the mining sector has strongly benefited from the global demand-supply gap brought about by reopening economies, the Indonesian export ban on coal, which directly benefits Semirara or SCC, and the Russia-Ukraine crisis that has driven up the latest surge in metal prices. Domestically, the lifting of the ban of open pit mining has also boosted prospects on the sector, as open pit mining allows for easier extraction of mineable resources, translating into lower cost margins, and the current opportunity to be able to export these out at the heightened global metal prices. These factors benefits names such as nickel, FNI, PX, Mark, and AT. For 2022, we forecast the Psci levels to hit 8,260 points as we expect corporate earnings to increase by 15% in 2022. With consideration to the current headwinds and tailwinds for 2022, an up and down range of 3% between our expectation of 15% implies a range of 8,000 to 8,500. On the key catalysts, our tailwinds are being validated with regards to further reopening of the economy and resulting improved business and consumer confidence as the IATF downgrades to alert level 1. Another key catalyst is the achievement of herd immunity by the end of the first half of 2022, which would further improve the Filipinos' confidence to return life to normal and the economic activities that it denotes. The increase in election-related spending in the first half of 2022 will most likely be pronounced this second quarter of 2022. The stimulus of enacted bills specifically create is a solid tailwind for the economy as companies have been reporting improved net margins generated from tax savings from the bill. On the amendments to the PSA, RTL Act, and FIA, as earlier mentioned, foreign response may be spurred by foreign investors exiting Russia and hedging risks in the European continent and may lead to a deployment of investments in the Philippines. And for our clients who would like to show, we would like to show several baskets that we have prepared for investors who would like to invest with a diversified approach. We have created and weighted a defensive and conservative basket, a basket that balances growth and conservation, and a growth-geared basket in line with your preference of risk. Our defensive basket is comprised of Reits, with the prospect of reasonable growth in value from the growth in weighted earnings per share, but more importantly, focuses on yields as guaranteed returns on an investment. And for our basket, our weighted dividend yield for 2022 would be at 5.3%. We also have a balanced basket that prospects outperforming the PSEI's corporate earnings growth of 15% by 16.1% and a relatively attractive dividend yield of 4.0%. How we crafted this basket is that we did mix growth stocks along and with defensive stocks of REITs to give a good amount of return, but still maintain a good dividend yield to allow for a defensive nature for the portfolio. Lastly, for investors who are geared towards capital growth, We have a growth-oriented basket weighted to outperform the PSEI's corporate earnings growth of 15% at 28.5%, while maintaining a dividend yield of 2%. For those interested and have any questions on our baskets, we invite you, our clients, to meet with us to allow us to discuss in detail and adjust accordingly in line with your trading strategy. Lastly, for investors who are interested in investing in just one or two stocks for the year, here is our top 5. Our first one is AC, and we like AC's exposure in strong rebound sectors in property and banking, along with sustained demand for power and logistics. As pseudo-economic trackers, the broad economic recovery will benefit conglomerates and will track the growth of its subsidiaries, with most listed companies on a recovery trend. Next, we like Ali. So strong demand for its residential properties and improving construction activities will sustain the robust growth of its residential segment, and the further easing of mobility restrictions will benefit its mall and hotel operations. Next, and under property is SMPH. And we like SMPH for its high exposure to commercial and retail space, with SM malls capturing the recovery story. The improving consumer confidence to go out and spend will help drive higher foot traffic for mall visits. Next is under power, which is Meralco. We like Meralco for that energy demand is seen to rise following the summer season, the easing of quarantine restrictions, the return of employees to their office workplaces, and the election-related activities. We expect demand in the commercial segment to continue to recover. And lastly, in the banking sector, BDO. Of the big three, BDO, MBT, and BPI, BDO stands out by having the largest commercial loan book. As such, the outlook of rate hikes in the coming quarters will benefit their net interest incomes the most. And here, should you consider investing in our top 5 as a basket, simply weighted according to its market cap, corporate returns if invested in a basket is estimated at 36.8%, and with a dividend yield of 1.2%. Lastly, for everyday guidance as we weather volatility this year, here we show our PE sensitivity between the 6,000 to 7,500 levels. Highlighted in green are established support and resistance levels in the past year. Gold is today's close of the index. What we would like to highlight here is that at the current level of 7,200 points, the 12-month forward PE is at 16.7 times and is actually a very good time to accumulate for investors with a long-term view, as the PE level is at a negative 1 standard deviation and at a substantial discount from our 10-year historical average of 20 times for the 12-month forward PE of the PSEI. In summary, as we navigate our way through 2022, we note the following notes to keep in mind. The Philippines is poised for domestic economic recovery this 2022. The easing of COVID-19 pandemic and downgrade to Alert Level 1 prompts clearer skies for our economic recovery trajectory. The next is with the U.S. equity outlook weakening due to the rising interest rate environment and uncertainty in European equity due to Russia-Ukraine crisis. Rotating funds out of these regions may flow into emerging markets, with the Philippines included. A key metric to monitor moving forward is inflation, as it will, 1, set the tone for the central bank's actions in response, 2, determine economic areas heavily affected by the current headwinds, and 3, influence the pace of broad economic recovery. Other catalysts to monitor are 1, the end of Russia-Ukraine conflict, 2, would be the easing of crude oil prices to at least $100 per barrel, and 3, China's ongoing surge of COVID-19 cases, which has led them to shut down several key factory cities, as well as most recently, their financial hub of Shanghai. And in view of these other catalysts, in our view, these other catalysts are transitory. And as these headwinds alleviate, these would be positive catalysts that would reinvigorate optimism in the Philippine equity markets. From a fundamentals perspective, while the market sentiment and consideration of the headwinds create significant selling pressures, valuations are currently attractive. And as the situation's changes progresses at a rapid pace, we expect volatility in the coming months. As such, dips may present discounted buy opportunities relative to expected fair values driven by economic recovery perspectives. Lastly, in managing your investments, we believe that clear investment objectives complementing risk profiles are the best approaches amid challenging times. And with that, we thank everybody for our portion. That is it for our market outlook and strategy. And before we go into our Q&A, we would like to call on our President and CEO of Unicapital Securities Incorporated, Mr. Toby Pañares, to help us wrap up our takes and share his wisdom on how investors can best manage risk and make good investment decisions during these challenging times.
Thank you, Gab, and thank you, Henry, for the outlook as well. And I also want to thank all our attendees for sharing the time with us and this afternoon. I hope you found the information shared by our speakers insightful and should be able to help you as well, each of your own investment decisions. As we come to the close of this webinar, the question I want to ask ourselves as the investors is, given what we heard, what should I do, right? What should I do now with my investments? So let me recap a few points made by the speakers, learnings that I saw. Best performers does not necessarily mean they're going to be the next better performance the following year, right? Earnings outlook is good for banks, property, etc. this year. And I think that is going to be the way it would be, regardless of who the winning presidential candidate might be, right? Stocks are favored over bonds. So the most important thing, I think, is decision needs to align with your investment objectives. There's so many risks. There's so many things we'll always be worried about. The global debt crisis, the inflation, the interest rates going up, which will impact, obviously, your investments. So if we keep on thinking about these risks, we will tend not to do anything, which I think is one of the first things that we should try to avoid. Because one thing is clear, there is no perfect investment. That I can tell you. If there was one, we'd all be there. And Gab, myself, and everybody in the investment world would not have a job anymore, because everybody will be in that particular investment. The thing is, there's none. But what I can tell you as well is there is always one that will make the most sense, depending on what you are investing the funds for. We can help you make those decisions. We don't have the time to explain each and every one of them for you. But bottom line is, do not invest, obviously, your emergency money on stocks, because you don't want to be pulling it out when it's down. History will also show to us, as has been mentioned by the speakers, that over time, over a long extended period of time, stocks have always done better. There's always worry. This year, they said the most worrisome is inflation, especially in the US, and the interest rates going up. Now, that tends to now make people say, so I'll just hold on to cash. Maybe I'll go to some gold. Maybe I'll go to some other assets. But we tend to not act on what it is. I read one time one of the financial experts say, the best time to invest the money is when you have the money. When you already have fulfilled your emergency requirements, your cash reserve, then you just invest it. But the key, again, is to invest it in what would make the most sense for you. And that we could help you with. And let me end this with a story. I promise to be brief. In 1994, because this reminds me, this worry right now reminds me of 1994 in the US. I was still starting in my career in the investments. I've been a few years into it. Everybody was saying this is not going to be a good year. Interest rates will be raised so many times. And true enough, that actually happened. And so people were not, don't go to stocks, don't go to bonds, etc. At that point in time, I just invested money in a mutual fund, which is invested in stocks. Now, people would probably say, well, why'd you do that? You knew the funds were, you know that it probably will go down. My point was, I'm investing this for my daughter's college education, which would be 18 years from now, because she was born November 1993. And true enough, the experts were right. Inflation was up, interest rate went up 6 times with almost 100 basis points rise in the last interest rate that the Feds did. And the bond market was really in a bad shape. Although I think, if I remember it correctly, the stock market still went up by 2%. The value of the fund that I invested in, and let's just say it was $100, became 70 the following, that end of the year. So the thing is, I did not sell, so I didn't lose the money. When I did sell it 18 years later, it was 5 times the value, and it helped me pay for the education, or the tuition, I should say. So why am I telling this story? Bottom line, you gotta invest in an investment vehicle that will achieve the objective that you're trying to do. You know, you don't want to buy stocks because people say that it's gonna do well. You gotta look at it, understand it, look at the valuation of it, etc. And I know Gab and our team has provided that. Active traders as well, you're being guided by Kiko on that as well. So bottom line is, understand what you're investing the money for. And I think you will find that you have a good investment vehicle to go with it. And with that, I want to thank everyone for attending, and I believe it's time for the Q&A. Thank you, everyone.
All right. Thank you, Mr. Pañares. So now we'll go into the Q&A portion, and I'd like to call back Sir Toby and Sir Herrera. So as we go through the questions, we can start with this one. One question that we've gotten from one of our participants. So with a challenging short to medium term fiscal situation in the country, do you think there will be credit rating downgrade risk for the Philippines?
Let me take a stab on that question. I think one of the rating agencies already mentioned that the outlook for the credit rating of the country has been downgraded. It's just the outlook at this point in time. But I think as we move into normalcy, we are still looking at the economy growing at close to 6%. In fact, NETA is forecasting 7 to 9%. I think the resiliency of the economy will help us weather through for another year or so. Depending on what happens, the risk factors that we mentioned, I think that is not coming soon in a year or two. But it could happen, but a lot will depend in terms of what happens next. It is not just based on fiscal deficits, because if it's just fiscal deficits or debt to GDP ratio, then other countries could probably be at a lower credit rating as well. In fact, if you look at emerging markets, those rated BBB, we're just in the middle of the pack at this point in time. There are other countries rated same as ours, which have higher debt to GDP, lower per capita income. So I think I do not see that happening in a year or two. Again, a lot may happen in the next 2 years, but that is probably out of the cards, in my view, in the next year or two.
All right. The next question that we have is, would REITs perform like the bond market, giving an increasing interest rate environment? And I'd like to give an answer to that. So REITs are always usually compared to treasuries in that it gives a specific dividend amount. And one of the challenges of REITs right now is to be able to offer a dividend yield that outperforms 10-year treasury benchmarks, which I believe is right now around 6.5% for the Philippines. One thing that we really like to consider when it comes to investing in REITs is that there is the aspect of asset injection. where property companies would infuse more assets, or for example, for C-REIT, they would infuse more solar assets into their company. And that is one thing that brings up the the asset value of these REIT issues. We've seen that in a REIT, that as every time they infuse the new properties, their stock price went up, even if it thinned down their dividend yields a little. So, in summary, one thing about REITs is that you get the asset appreciation through the infusion, as well as having a dividend rate to keep your portfolio defensive. Okay. The next question is it advisable to invest in gold or other asset classes amid global uncertainties?
Maybe I'll give my 5 cents worth on this, Gab, if you don't mind, and feel free to also add.
Yeah, sure. Go ahead.
If I may give the views of a lot of the global multi-asset managers that I sort of speak to or look at. What's really been happening typically in a situation where you don't have good outlook on stocks, you don't have good outlook on bonds, and the situation we're just in, obviously, if you were invested actually in oil and gas stocks, you would have done very well, or gold, or commodities, because that's where typically the rotation happens of the money goes in. They will put more weight. If from an asset allocation standpoint, I should say, they will now become overweight in those type of asset classes like gold and commodities and alternative assets, as we call them. But the key, and I want to say it again, the key is to have a good asset allocation, and the portfolio should be, in an ideal scenario, should be invested in each of these different asset classes. The challenge for us Filipinos in the past and up to now actually has been always like, well, typically if you want to invest in gold or other gold and even before at commodities as well and REITs, it was not readily available here in the Philippines. If I may do a quick shameless plug, we tried as much as possible to make this available for our retail investors. And about 2 years ago, we relaunched a Unicapital co-managed by Atram Global Diversified Funds. And it's actually invested in global assets, meaning global equities, global bonds, but with a very big tilt as well towards the Philippines. Being Filipinos, we tend to obviously be domestic biased. So it will also be invested in Philippine equities and Philippine bonds. But that also, that particular fund was also invested in gold and alternatives. In fact, it was one of the major, from an attribution analysis, it was one of the reasons why it did perform very well in 2020. And I believe, if I'm not mistaken, it was the best performing balance fund in 2020. So the kind of investment that is now available to us is there if you want to have some exposure in gold, but you can't afford the $50,000 or $100,000 minimum investment that we have. Through Unicapital, and certain partners, you could invest in gold. This is probably one of the simpler ways because somebody's looking after it for you, making the day-to-day investment decision and managing the portfolio. And the best part actually is you don't need $100,000. I think you can start off with 10,000 pesos. So you're investing in pesos as well. So many choices, but yes, it's good to be in gold as well, and it's good to be in different asset classes at this point. Thank you.
All right. Thank you, Sir Toby. It's good to know that on top of the Philippine equity opportunities that we show, we are also able to offer to our clients investments in other asset classes, and not just in the Philippines, but also in global markets. Okay, so and the next question that we have is, how do you project the local stock market growth versus that of other countries? I think Mr. Herrera, you would have a good idea on how to
Right.
approach this.
Let me share with you my uh, understanding of how we look at different countries. Of course, there are a lot of variables, but clearly in any investments, for me, what's critical really is that the starting point is that the earnings growth of the companies, and then you will have to look at the valuation of companies. That's why I think in my talk earlier, I mentioned that in the US, my concern was that uh, valuations are quite stretched, while corporate earnings are coming in, but the valuations are stretched. I think most studies are showing that valuations are not as stretched in emerging markets compared to advanced economies at this time. So for me, very crucial will be really the price earnings ratio and the earnings growth. I mean, I do recall a reading that I had coming from Peter Lynch, and he was saying that a normal thing will be earnings growth will be equal to PE ratio. Like if the earnings of corporations will be growing at, let's say, 40% per year for the next, let's say, 3 or 5 years, you don't mind paying a 40 times PE. On the other hand, if the earnings are growing just 8%, a stock that might seem cheap at 8p, it's cheap because there's a reason, because the earnings growth are not as substantial. So for me, it's critical to look at the relationship, or sometimes they call it PEG, price to earnings growth. So higher than one will be something that is not good. So you want a low PEG ratio, meaning the growth is much faster than the PE ratio. That's one of the critical things I use when I try to spot bargains, and I look for companies between a company and the other. So between countries as well, I think Bloomberg, even your handsets, could give you indications of the price earnings ratio of the entire marketplace. You have to go to individual stocks within the companies or the countries composite indices to look at individual stocks. So that will be my way of measuring and an indication on what will be good or bad, and what will be something that will be looked after. So if I were to look at the Philippines, we're coming out of the gates very last because of the longest lockdowns that we had been implementing in the country. So we're just starting our race, and the rest have gone out of the race. So we're doing a catch up, and as Gab has mentioned, on uh, residential units, in terms of power as well, mobility, we are just seeing an increase and back to previous levels. In fact, some of these indicators are even showing higher than previous levels. So those are the key indicators for me to say which countries will be good to look at.
All right. And I'm currently thinking that given that the emerging markets focus with all the tensions happening in other continents, emerging markets with the Philippines being part of it, would actually have a good inflow in the coming quarters once all of these headwinds of heightened prices of oil, input commodity prices would start to alleviate. Okay, the next question that we have, what would be a good stock portfolio allocation to do during this current situation? And for example, having a 60% cyclical and 40% defensive. Okay, with this one, we presented their three baskets earlier on, and we really have weighted it. We have created three to be able to fit investment objectives and risk tolerances of specific clients. So we do have our defensive basket, which for conservative clients who are looking to conserve their capital and would like to make returns on dividends, we do have that. We do have that basket. Our second basket we balance with growth and defensive stocks. So that would be where we put cyclical and defensive stocks. We put an exposure there for you to be able to outperform at least the 15% expectation of corporate earnings growth for the PSEI stocks at 16.1%, and still with a dividend yield of 4%. And then lastly, for those who are really looking for capital growth, although with a little bit higher risk compared to our other two portfolios, we do have our growth geared basket where we're looking to, we are hoping that corporate earnings would be at par to around 26% by the end of the year, and still offers a little bit of a dividend yield of 1.2%. So with that, the allocation would really be down to investment objectives and the risk tolerances. Once you've identified that for yourself, you would be free to choose which basket that you would want to invest in within your portfolio. And again, as we know that everybody will have their own preferences and beliefs, our baskets are recommendations, and we'd like to invite you to sit down with us if you would have any more preferences that you would like to put so that we can adjust and tailor fit a basket for you. All right, and the next question that we have, can we expect that there is a likelihood that the Philippines may also experience the same surge in COVID-19 cases happening in other countries currently? Well, for that, we've already had our surge. That was the surge that we had in January. All these other countries were not having that surge at that time, and that was the Omicron surge. So the other countries that are going through this, it's their turn for their Omicron surge to spread. So if we look at the likelihood of this happening, there may be should the new variant come up. But what Omicron has taught us is that the vaccines have been resilient in battling the grave illnesses. And as you all know, Omicron did have record highs in terms of surge, but did not lead to grave illnesses as we saw in hospitalization rates and death rates. So as we move forward, we are looking that we are seeing that we are really moving into an endemic scenario. Even in the past month when we moved into alert level 1 and there's heightened mobilities and we can see a lot of rallies happening for the elections, we have not yet seen a new surge in infections. So at least for that, the risk is low. Okay. Next few questions. All right. What funds does your company offer in relation to the select stock picks you presented earlier? Can you discuss briefly their 2 to 3 year and year-to-date performances? Okay, what funds? And in addition to that question, do you also offer global stock funds? I think VDP would be best suited to answer for the global stock funds. For the funds that we offer, I know that we also have few, Sir Toby. But for the select stocks we presented earlier, those are recommendations that we've crafted with the intention to be able to offer different risk profiles, a good way of investing. And if we look at their 2 to 3 year and year-to-date performances, well, 2 to 3 years they were affected by the pandemic and went down. It was going up already, but we had now we're having a turbulent start to 2022. So in terms of year-to-date performance, some of those stocks and those baskets are currently down. And for us, we believe that stock that has a very low stock price but very good fundamentals are good stocks to invest in for the next leg up.
I think it's also better say it's also best to clarify, if I may add to Gab, that the funds. Sorry, I misused the word. The portfolio or the basket of stocks that Gab showed is not a mutual fund. So just to be clear, that's why it does not have a 2 or 3 year return. Historical returns, if that's what the question was about. I just want to sort of make sure that I understood it as well correctly. So the other thing is we are an open architecture. When I say open architecture, we have different partners that we could actually help our customers with their investment objectives. And I believe that one of the earlier question was, do we have global or funds that has exposure to global? The quick answer is yes. There's fund managers that we are partners with who does feeder and feeder funds that we could actually invest into, US, a pure US equity. There's some that the theme is consumer discretionary. There's even one with a technology or a global technology fund. So there's different ones. I guess the quick answer is there's different ones, and it's best that we talk, or if you could talk to your salesperson within Unicapital, and Marlene and I as well would be happy to guide you as well as Paulo. Thank you.
All right. And well, so while we don't have any further questions in the queue, I think there is one question that I think all of us could help answer. Given that where we are right now with the headwinds and the tailwinds that are currently affecting the Philippine economy and world economies, from an investor standpoint, is it a good time to enter the markets right now?
Let me take a stab at that first. For me, it's not about timing, whether it's now or a year from now. If you have the money to invest, you just have to look for the right asset class. Are you going for bonds or stocks? Because, keeping the money in bonds or in stocks, there are as well risks because, markets might be moving ahead of you, or, you might be positioned in the wrong stocks. So it will relate to your risk profile, your objectives as well. Would you need the money in 1 year's time, 2 years' time? If it's a long-term investment, I think Toby has mentioned to us that, for the long term, I think equities will still be the best at this time. We look back in time. I think the last Asian financial crisis, the stock market went down from 3,300 to 1,000. And then the next global financial crisis from roughly 3,900 to 1,900. First was a 66% drop, then the second one was a 50% drop. In all these times, I mean, the next years after that, the market zoomed from 1,000 to 3,500, from 1,900 to almost 9,000. So if your investment horizon is for the long term, I think with interest rates at very low levels, although they're starting to increase right now, stocks will still be the right asset class over the long term if you're in the Philippines. I think the good thing about what has happened also in the Philippines that funds that are invested overseas are now being made available. If you back in time, I remember we were trying to get SEC to get approval for investments overseas. And SEC then, this was about 15 years ago, they were saying, we're trying to attract investments locally. And here you are, you want to invest outside the country, put the Filipino long-term investments outside of the country. But right now, because of the situation, we're no longer that constrained about our dollar positions, dollar reserves, then we have that opportunity to be investing outside as well. So I think it's incumbent upon us to take a look at the opportunities, not just locally, but also overseas. But for me, the thing is that, okay, if I see that the next president may not be viewed favorably by foreign investors, because we've seen that they have been driving the movements in the local exchange, there are options. I will still have to keep funds in the Philippines because all my majority of my expenses will be in pesos. You also have to look at your asset and liability matching. You don't just take unnecessary currency risks as well. So that is how I'll do it for myself. And the main thing about long-term investments is that it's not about market timing. Studies have shown that really it's the asset class that's very important that will determine the long-term returns on your funds. Not timing, not selecting the particular assets. So there are basically three major sources of variability in long-term returns. The asset class itself, you selecting the particular assets that you selecting the stocks rather than just the index, and then market timing. Do I invest right now? Do I wait for 6 months? Do I invest only 50% of my funds? I think over the long term, the longer you keep your money invested, the bigger chances you have of outperforming the returns. Because keeping your money in short-term rates, you might be falling behind the inflation rate. So purchasing power-wise, that might be declining over time. So it's your horizon as well when you need the money. So that is how I'll answer that. There is no right, no wrong answer. That Toby has mentioned. It could be a bad outlook, but again, markets discount. Markets are forward-looking. In the same manner, if we look back, February, we still didn't have a case of COVID in the Philippines, and yet the stock market kept coming down. By March, when we had locked down the economy practically, then the stock market started to go up. markets are forward-looking. So at any single point in time, it's in equilibrium. So each one of us is trying to outdo each other. Like, is it cheap right now? What are the risk factors ahead of us? So no one knows what the future lies, what lies in the future. But it is about the time that we spent invested rather than trying to time the market. So that is important in my view.
Yes, yes. So a long-term investment is actually what will really give good returns to an investor who are interested in any asset class for that matter. On our side, when we look at focusing on Philippine equity in the PSEI, as we know, when the pandemic happened, the markets went down to almost 3,000. The PSEI went down to almost 3,000. And while everybody was panicking and selling off assets, for a lot of other investors, it was actually a very good time to buy. And you can see that those that were able to get the few shares, especially when it dipped down to 3,000, well, they have very attractive returns by this point with the market at 7,000. And for those 2 years of the pandemic, how the market acted is that it was trying to rationalize growth amid living in a pandemic situation. And now, for where we are, we've already passed the pandemic recession. Uh, our country and all world economies are already on a recovery growth trajectory. And despite having these headwinds and tailwinds, what we are appreciating about this in terms of entering an investment is that these are keeping valuations at attractive levels for investors. And what Mr. Herrera mentioned is that we are forward looking for the next leg up when these factors alleviate, oil prices ease, and the Russia-Ukraine conflict ends. Essentially, when the situation balances us out for world economies and we're able to go back to pre-pandemic life and post-conflict life, the stock market will have a good pick up in the next coming years. With regards to the presidency, sure, they may be a catalyst for growth or maybe a catalyst for risk aversion, but at the end of the day, given that we're coming from a pandemic recession, everything is pointing on the way up, and the economic recovery trajectory is pointing on the way up. And as such, moving forward, even if we have muted the inflows in the stock market, corporate earnings will continue to grow through that period. And fundamentally, those are very good things to buy. Even if you may have to look at the value that you're going to extract from it, maybe 3 or 4 years from now, at the cusp of where we are right now with a lot of uncertainties and a lot of headwinds that could bring the market down or bring the market up, this is a very good base point at 7,000 to look forward to a higher PSEI level in the coming years. So for us, it would be a very good time to invest.
Yeah. Gab, if I may add, you just mentioned about the foreign flows. No, in fact,
Yes.
for me, that's more of a positive than a negative right now, because if we've seen the numbers, the last 4 years, a lot of foreign outflows have happened. In fact, I was looking at the emerging market positions of some of the funds investing in emerging markets. They have underweight positions in the country right now. You know, so I don't think that there's a lot more foreign selling that's out there, and there's more upside if we come up with some surprises with elections or earnings of companies listed in the stock exchange. So for me, foreign inflows or outflows at this time, there's more upside than downside, given the fact that they have exited the country in the last 4 years.
Yes, and for a time that there's a lot of foreign outflows and they're holding very little foreign ownership here, giving us an underweight rating, as you've said. Once these factors alleviate, we will climb up on the weightings again from neutral to overweight, and that would mean that domestic investors who would want to hold right now could benefit from the next wave of foreign inflows moving forward. Yeah, and that's a very good position to be in as a holder, as a position for holding stocks at the moment or buying into stocks for the moment. Okay.
Maybe I'd like to also add a particular favorite of mine.
Okay.
a stock, because you mentioned some of the stocks that Unicapital is also looking at. I like a stock that I've been left behind in the past. My favorite stock years ago, which I used for the education fund of my kids, was Jollibee. At 10 pesos, I bought Jollibee years before some of you were probably born, or were little kids still. And then, went up all the way to 90 plus, and I sold out. I thought, oh, I made 9 times my investments in Jollibee, only to find out that it went all the way up to 300 plus. And then when it went down during the pandemic, I went back in around the 90s level. This was the time I left Jollibee, because I thought at that point in time it was trading at expensive levels, 25, 30 PE. That's quite expensive. I want to see it come down first before I will go in. But I guess if you look at markets in the US, for instance, if you look at Amazon right now, Amazon's probably trading at over 30 PE. And 2 years back, in 2020, I said my favorite was Jollibee stock. And somebody was mentioning to me, but Henry, Jollibee was losing money in 2020, and his choice was Amazon. And I was saying, well, Amazon was doing record income levels. It's not about the current earnings; it's about the future. I like Jollibee, for instance, because the plan was to open up 500 stores per year, at least for the next 5 years. So the valuations might be expensive right now, as I mentioned earlier in my answer to an earlier question. It's not about cheapness in terms of PE ratio. It's about the earnings growth as well. That's very important.
Yes.
It might be trading at a high PE, but if you are seeing sustained earnings growth in the next couple of years, because the PE will be reducing every year because of high earnings growth. So I caution people to just be selecting stocks with very low PEs. There is a reason why those stocks are trading at low PEs, and there are also reasons why certain stocks are trading at very high PEs and are continuing to post strong price increases over time. So I guess for those who have not had the years like I did, I started investing in 1986 in the stock market. No? So I felt all those ups and downs all those years. And what has made me stronger is that each up and down are lessons learned, and that it further strengthens your resolve and your understanding of markets. Even to this day, I still learn a lot about what's happening. I try to interpret how I can move on those things. So that is something that I want to share to our listeners right now. That it's a long process. There are no right or wrong, but make sure that you understand you have a trading plan, and then you plan your trade, and then you trade your plan.
All right. Okay. We do have a question of what happened to Ddmpr. That's the REIT of Double Dragons. Well, simply put, most of its tenants were POGO companies right before the pandemic hit, and most of them vacated the premises when the lockdowns happened. So with the premise of having POGOs as their main tenants, they haven't been able to recover as well as other companies have already been recovering. So that is one of the biggest headwinds that Ddmpr has right now. All right. Okay. So with that, we wrap up our 2022 market outlook. And we're sure there are still some specific questions on everyone's minds with regards to their investments and how to invest this year amid the turbulent times. And for that, we highly encourage everyone to reach out to us, and would be happy to assist you in tailoring an investment plan with the use of our recommended baskets. Before we end our presentation for the day, we'd like to invite everyone to participate on our short post-event survey, and the link will instantly open once you leave this webinar. And with that, we'd like to thank everyone for taking the time to join us and listen in. We'd like to thank Mr. Herrera and Mr. Pañares for sharing their wisdom, and wish everybody a good investing days ahead. Thank you, everybody.
Thank you,
To everyone.
everyone.